What are stocks? The stocks are a type of investment that can generate returns. Also, it is a source of raising money for a business. Let's talk about both these perspectives of stocks. There are generally two types of investments: redeemable and irredeemable. The redeemable investments are returned after the maturity, like bonds and fixed deposits. The investors keep on receiving interest till maturity. The stocks are a type of irredeemable investment, equity of a company that are not returned back to investors. It represents percentage of interest of investors in the company's worth until it running. Now let's see how company raises money. Suppose there is small company and it needs to expand. When companies need to expand, they need money. There come the two main sources, debt and equity. To raise funds by equity, the company has to get registered and get listed on the stock exchange. Then the general public wishing to invest in stocks can reach the stock exchange. Let's say the company gets registered with stock exchange successfully and initiates an initial public offer of its 100,000 stocks at a price of $50 per share. Now the investors will pay and receive their desired number of stocks from the stock exchange. This money keeps accumulated into company account until the required funding is attained. With this money, the company can take up profitable expansion projects and generate profits for the company, and after a year the company grows. Let's say company has done well in the first year. It announces a dividend of $2.50 per share. Now this $250,000 will be distributed as a return to investors who own 100,000 shares. Suppose the company has improved performance and it can be forecasted that the company will perform even better in future. The price of stock increases to $75 per share. Now at this point the investors can make their profits. Let us see how. Let's say Mr. A wants to sell his 100 shares and approaches the stock exchange. The stock he purchased for $50 is trading now for $75. Mr. B, who thinks that the company will perform even better in future and wants to purchase 100 shares for $75 per share. Now at the same time Mr. A and Mr. B are exchanging shares worth $7,500 which Mr. A originally purchased for $5,000. Thus Mr. A will make a profit of $2,500.